Welcome back to Morning Trade Live. Time to go inside out on Amazon. Joining us now, I'm pleased to say, is Frances Stacey, economic strategist and wealth manager, Scarlet Oak Financial. Thank you so much for joining us, Frances. What's your expectation? Because it just seems that every year we hear about this, it continues to break new records. Do you believe that that trend can continue?
I do think that the trend can continue, and it was notable that he moved it from 2 to 4 days this year. And last year they had 14 billion, and so I'm assuming that their calculus is that they're trying to double that. Of course, it's really small considering their overall revenue, but 55,000 U.S. retailers did over $1 million, and you had over 200 million items last year. So giving that a 4-day window is probably going to increase that a huge amount.
I've been covering China for many, many years, and so I've seen a lot of these shopping festivals being extended. It seems that a lot of consumer fatigue has set in when it comes to just how many we see throughout the years, doubling them in size. I mean, there are some festivals in China that go for 6 weeks sometimes when you look at the likes of Alibaba, for instance. I'm just curious when you sort of apply that mentality to what we're seeing from Amazon now. What does that tell us first and foremost about inventories? Let's start with that.
Well, the thing is that you had some consternation around the original tariffs announcement, right? And so you could still potentially have people stocking up, thinking that prices are going to go up in the back half of the year, depending upon tariffs and tariff volatility, et cetera. I do think, to your point, that when these things get too frequent or too extended, that the impetus where somebody might buy something that they've been holding off on probably dies. There's probably sort of a point on that curve when it takes that sort of excitement away. For me personally, I buy so many of my household goods on Amazon because of the convenience of having it come to my door. And this has sort of revolutionized how people shop. So I'm kind of, it's kind of fun for me to get some deals on those things. I don't know that this is going to push me personally into, stretching for a big ticket item that I wouldn't otherwise purchase. But I do think that there are a number of people in that category. So I expect a phenomenal turnout this year.
Yeah, as one guest put it earlier this morning, it's obviously a good day for sales, but not for margins. Some of the beneficiaries for Amazon, no doubt, is whether we see more people signing up for Prime, but also some of the advertising around that 4-day event. So, I mean, how are you looking at that as far as the fundamentals are concerned for this company?
Well, the fundamentals for the company, as I said, this is just a very small percentage of the overall revenue, $650 billion, and that comes from a multitude of sources. But that being said, I think it is going to push some of the inventory, which will then force these sellers to restock. And, hopefully ahead of tariffs, there may be some impetus around that. Other than having, just a longer sale, which pushes more sales in a shorter period of time, I don't know that it's going to have a huge impact on the stock. Amazon today is flat. I think more Amazon is going to be affected by tariff type stuff and also macro factors that affect the sector overall. I think, quite honestly, in the back half of the year, if we have bond market volatility around tariffs, I think that that's going to be the biggest mover for, the biggest catalyst for some kind of change and volatility in the stock market, as we saw, previously, in the early part of April around Liberation Day. So I would expect Amazon to continue to trade as is. I would expect their revenues to kind of stay in line. I wouldn't expect this to affect margins too much because, again, it's such a small percentage of their overall revenue.
Yeah, it's interesting, obviously relying on third-party sellers, no doubt, dominating as well. Just getting back to what I've seen in China, there has been certainly pushback from some of those third-party sellers to the big companies who don't want to deploy these sort of aggressive discounts on these shopping events because, they've got to protect their own margins. I mean, do you suspect that we could see something like that, or do you see that happening as far as a trend is concerned?
I don't know if we're going to follow suit, as you've said, with China, as far as just overdoing that to the point where it does aggravate third-party suppliers, whether it does aggravate margins, whether it kills demand. I mean, there are optimum levels on the curve. I don't think adding an additional 2 days is going to move the needle too much on that. But it is interesting how it is dominated by third-party sellers. And as Amazon becomes increasingly reliant on them, they will have increasing leverage over the company, though I don't think this 4 days is going to move the needle on that.
Okay, good to know. Frances, thank you so much for joining us. It's been a pleasure talking to you and really appreciate your insights and analysis today. Frances Stacey joining us there. Let's trade it now with Tom White, the co-host of Fast Market. And how are you looking at an example trade on this, Tom?
Yeah, if you have to take a look at the, Sam, the earnings, they report at the end of July, early August. Nothing's confirmed right now, so I think you got to take that into consideration. Implied volatility levels actually pretty low at this point. The IV percentile rank only about 25%. So we're in the bottom fourth of what we've seen in implied volatility over the past 52 weeks. So that gives you some opportunities with directional biased trades. So I went out to the July 25th weekly cycle here, about 18 days to expiration, where I can avoid that earnings event, but take advantage of a rally if we see that into these prime days. With this type of strategy. So buying the July 18th, the July 25th, the 220 strike calls, and then against it to offset some of the costs on that bullish call purchase that's slightly in the money. We're going to sell the 235 strike call. So a bullish $15 wide call vertical, you're going to pay roughly about a $6 debit for it. The debit you pay is going to be your risk on this position, $600 per spread. That can expand to $1,500 if it gets above 235 into expiration on this one. If you pay $6 debit, break even 226 to the upside. That's just about 1% above the current share price. So you don't need a massive move to the upside. You just need this thing to grind higher. And then because you're buying a directionally biased call vertical here, you have some flexibility as far as trade management goes. You don't have to wait the full 18 days to expiration to get out of this trade or close a portion of it. If this thing starts to expand, you can close maybe, a portion of your position. If you're doing multiple contracts, you can close the whole thing. So it gives you some flexibility in that regard, trying to take advantage of maybe a rally into that earnings event.
Okay, and you've got a sort of more neutral trade for us, example trade. What's that, Tom?
Yeah, this one's don't be a hero type of strategy. It's still directionally bullish on this one, Sam, but it's giving yourself a better probability of success. With the last example, buying the call vertical, you need a move to the upside, right? This one, the stock can actually go higher, stay where it is, or go a little bit lower, and you can still be profitable on this strategy, but it's about trade-offs and higher probability of success. So going out to the August 1st weekly cycle, you've got a little bit more added volatility and duration on this one. We're going to sell an out-of-the-money put spread. We're going to sell the 210 strike put, and then buy the 200 strike put. So a short $10 wide neutral to bullish put vertical. You're going to collect roughly about a $2 credit on that. That's what you can make on it, $200 per spread with $800 in risk. But what it does is it takes your break even where you start losing money all the way down to 208. So you're giving yourself basically about a 6.5 to 7% cushion to the downside before you start getting hurt on this one. Your probability of finishing out of the money at expiration on that short 210 strike, you want that elevated, right? So it's about 70% at this point, 70% chance that Amazon will be above the 210 strike at expiration. So those are those trade-offs that we talk about in these neutral to bullish type strategies. A little bit more conservative, giving yourself a bigger cushion to the downside and still can remain profitable on this type of trade. And you're taking advantage of that higher implied volatility level.
Great stuff, Tom. Thank you so much. Really appreciate it. So that was a look at Amazon ahead of those prime days.